Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings so you don't have to. Today we're diving into a Form 8K from Amplify Energy, and let me tell you, it's got more twists and turns than a Texas oil pipeline. We're going to unravel some merger drama, potential lawsuits, and a whole lot of financial analysis that might leave you scratching your head. But don't worry, we'll break it all down in plain English. So Amplify Energy is in the middle of a merger. Think of a merger like two companies getting married to become one bigger company. Amplify is trying to merge with North Peak Oil and Gas and Century Oil and Gas subholdings. It's a pretty big deal for them, aiming to increase their scale and improve their financial returns. The original announcement was back in January. Basically, they are merging with two other companies. NPOG will merge into First Merger Sub, becoming a subsidiary of Amplify, and COG will merge into Second Merger Sub, also becoming a subsidiary. To make this happen, they need their shareholders to vote yes. They sent out a proxy statement, which is basically a document explaining the merger and asking shareholders to approve it at a special meeting in April. Think of it as a detailed proposal they're sending to their investors for approval. But here's where things get interesting. Some shareholders are not happy. They're claiming that the proxy statement, the document explaining the merger, is missing important information. They've sent demand letters and even filed lawsuits saying Amplify isn't being transparent enough about the deal. They think they're not explaining it well enough. These unhappy shareholders have filed lawsuits, claiming the proxy statement has problems. Amplify is fighting back, saying the claims are without merit, meaning they don't think the claims are valid. But to avoid any delays or extra costs, they are adding some extra information to the proxy statement. It is like when you argue with someone, and even if you're right, sometimes you explain yourself to end the argument. So Amplify is adding extra details to their initial statement, just to be super clear and avoid any legal issues. Even though they don't think they have to, they're doing it anyway to keep things moving smoothly. This new information is considered a supplement, meaning the existing information is expanded. Originally, the board of directors were looking for opportunities to grow the company since May of the previous year. They hired Houlihan Lokey to help them consider all the options, and they talked to a lot of different companies, both public and private. The goal was to make Amplify bigger and better. During all these discussions, Amplify signed one confidentiality agreement that had a standstill provision. A standstill is basically an agreement not to try to take over the company. This particular agreement wasn't with Juniper, who is involved in the current merger. Houlihan Lokey, the financial advisor, looked at other similar companies to see how Amplify stacks up. They chose companies that were similar in business size and location to help determine the value of Amplify. It's like comparing apples to apples. The companies were chosen because they were similar to Amplify and the companies they're merging with. They looked at things like the type of business, size, and where they are located. Houlihan Lokey analyzed a group of companies to see what their enterprise value, basically a measure of their total worth, was compared to their adjusted EBITDA. Adjusted EBITDA is a measure of a company's profitability. They found the following multiples. They calculated the enterprise value to adjusted EBITDA for 2024, 2025, and 2026. The average of all the companies that they analyzed, their enterprise value was around 4 times their adjusted EBITDA. The multiples ranged from 3 to 8. Taking all this information into account, Houlihan Lokey decided on ranges to value Amplify. They estimated the value of Amplify based on its expected earnings for the next few years. This analysis gave them a range of possible values for the merger. Houlihan Lokey also used a discounted cash flow analysis to estimate the value of Amplify and the companies they're merging with. This involves estimating future cash flows and discounting them back to their present value. They looked at different pricing scenarios, including current market prices and consensus estimates. They estimated future revenue for natural gas and crude oil for multiple years based on the current prices and consensus estimates. For 2025, they estimated around 350 SIN for natural gas and $70 for a barrel of oil. Going forward, Houlihan Lokey also did another calculation, looking at terminal values. These calculations resulted in more potential values for the merger that are ranging from around 40 to 70 million. It's important to know that Amplify's directors and executives might have some personal interests in this merger that are different from regular shareholders. The board knew about these interests when they made their decision. The CEO of Amplify and the chairman of the board are expected to remain in their positions after the merger. As of right now, there haven't been any talks about new employment agreements or compensation changes related to the merger. As of the date of this proxy statement, No discussions have been had with any of Amplify's directors or executive officers with respect to any new arrangements regarding their employment, compensation, or benefits in connection with the transactions. Now, here is the boilerplate. The company issues a warning that a lot of these statements are estimations of the future and may be incorrect. Many things can go wrong and are unpredictable, so do not make decisions based solely on these statements. Please read all SEC filings if you want to invest in this company. If you are considering investing in Amplify, make sure you read the proxy statement carefully. It has important information about the merger and the risks involved. You can find it on the SEC's website. Amplify and its directors and executives might be considered participants in the process of asking shareholders for their votes. Information about these people, including their interests, is in the proxy statement. The report is signed by Martin Wilshire, President and CEO of Amplify Energy Teed. Now, my take on all this is pretty direct. Amplify is trying to make a big move by merging with these other companies. They think it will make them stronger and more profitable. However, some shareholders are skeptical, and these potential lawsuits are definitely a red flag. The added disclosures are a good sign that Amplify is trying to be transparent, but it remains to be seen if it will be enough to appease the unhappy shareholders. Financially, the numbers are all over the place depending on which analysis you look at. This makes it difficult to get a clear picture of the true value of the merger. There are multiple ways to measure what a company is worth, which results in different valuations of this transaction. Overall, this merger is a risky move for Amplify. It could pay off big time if everything goes according to plan, but there are plenty of potential pitfalls along the way. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives.